My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I help people make friends. I'm just trying to make you some money. My job is not just entertainment, but to educate and teach you, so call me at 1-800-743-CNBC. Tweet me at Jim Cramer. No, the banking crisis isn't over. But on the other hand, at least there's a way to handle troubled banks, a way to get out of this jam. Oh, and to be sure, I'm downgrading this one from crisis to jam. Because if you're jammed, you can get unjammed. There's a way out. That's what happened today when we learned that some medium-sized outfit named First Citizens Bank shares had to look up the darn symbol, took over the failed Silicon Valley Bank's branches, loans, and deposits. It is a sweetheart deal because they're buying $72 billion in loans at a $16.5 billion discount. Now, the $90 billion SVB securities will remain in receivership. I think a lot of those Silicon Valley Bank loans, by the way, are going to turn out to be good ones. No wonder First Citizens Bank shares saw its stock soar nearly 54% today. That cast a rosy glow in the whole session, allowing the Dow to gain 195 points. S&P advanced 0.16%. NASDAQ dipped 0.47%. I'll go into that relationship in a second. So is this the solution for our bank-run problem? I wish. The reason this deal works is that the government already owns Silicon Valley Bank after taking the stock to zero. This kind of thing only can happen in receivership after a bank has already failed, because that can eliminate a lot of risk for the buyer. Our system simply isn't ready for a wave of bank failures. That's not an ideal solution, which brings us back to First Republic Bank, the one that looks the most like Silicon Valley, with a stock that's traded as high as $16 and change today, but falling back to $13.82 and an anemic close, although it's still a 12% rally from Friday. The opening rally, though, today, in retrospect, was premature. No bank is likely to step up and buy First Republic whole and not in receivership, because it'll immediately hurt the quarter. That's the only way they can do it, in receivership. And that's not going to happen. There's no guarantee. Well, I guess it could if things really go bad, but there's no guarantee, no indemnities, no deep-pocketed partner that makes you whole if things go wrong. First Republic has to go down before a good deal can be worked out, unless the FDIC can somehow indemnify the buyer from losses. And I have to tell you, I've worked hard on this. I can't come up with a way it can be done. That's the bad news. But the good news is the government now has a plan. If there's another old-fashioned bank run, you just close it. You zero out the bonds, zero out the common stock, and you find another First Citizens to buy what's left, because we saw that stock jumped more than 53% when it got this deal. What does this mean for the stock market? Well, it's frankly not easy to reconcile. We know there was a big slowdown in deposit flight last week across the country, with less money moving out of the regionals into the larger, safer banks. That's positive. But we also know that if the outflows start up with any velocity, say at First Republic, maybe the process will start all over again. Which brings me to what really matters. Last week, the Fed decided to raise interest rates by 25 basis points and not 50 basis points, as many thought could happen a week before that, because it was concerned about these banking crises. Now it's gutting confidence at the worst possible time for our country. While the Fed wants inflation to come down, it doesn't want it to come down in the worst possible way, which would be as a result of more bank failures. The good news is that we now know there'll be other banks like First Citizens Bank shares that are trying to figure out how much they can make if they get involved in one of these situations. You can have your stock double, sell stock, have more money come in. It's a virtuous circle. The bad news is this kind of bank collapse has a similar impact to another rate hike from the Fed, and not just a quarter-point one. Of course, First Republic isn't like Silicon Valley Bank, which fell apart in 48 hours, because it had a very concentrated deposit base, namely some large venture capital firms and their portfolio companies that bolted almost simultaneously. First Republic's deposit base could be a little more intrepid. Some people would say sticky. But if you're making these decisions at a business, you don't want to be a hero, right? You're like, oh, I'm going to just put my money in there and just hope everything does well. Just to keep the money in the struggling regional bank where you aren't protected above $250,000 worth of FDIC's insurance. And many of First Republic's, by the way, their customers are very rich and they have a lot more money than they may have coverage. Of course, First Republic isn't a sitting duck. It can borrow money from the Fed at decent rates. It can figure out how many of its depositors are protected by the $250,000 limit, then borrow to fill the gap if the government will let it. I think they will. I know I don't sound all that worried. And honestly, while I am chagrined, I am more positive than last week because here's what's happened. I care about velocity, and the velocity of the run on the banking system has slowed. It's gone from pell-mell just last Wednesday when Janet Yellen told Congress there was no master plan to save the banks to less worrisome, at least for the moment. The regulators are finally getting out of the situation. That matters. I think they're going to have a plan. It's actually going to inspire confidence. I think they can make us feel like there's no need to flee from our regional banks because depositors will get bailed out. Don't worry. That was what we thought was happening last week when Fed Chief Jay Powell seemed to indicate, don't test us, we'll be there. But Secretary Yellen, at the exact same time, perhaps to please the boss, said no bailouts. Even as it's hard to call making depositors whole a bailout when the shareholders and the bondholders get wiped out. You aren't doing a bailout when you destroy the investors and the creditors. Let's step back a second. If this market's ever going to stop the one step forward, one step back nonsense that you know has existed forever, the Fed needs to cut it out with the rate hikes. Unfortunately, they won't do that until wage inflation cools dramatically. Remember, that's the issue, is wage inflation. How do you stop wage inflation? Well, it tends to vanish on its own when you have less business expansion, which the Fed can engineer with rate hikes by making it more expensive to borrow money. If this leads to wage stagnation, it crushes housing and auto demand, causes people to fall behind on their credit cards, and that's how you whip inflation now. Of course, there's another faster but far more dangerous way to arrive at the same outcome. When you get a financial panic and banks start worrying about going under, they become a lot more cautious about lending money to you, which results in the same slowdown in business expansion that you get with enough gradual rate hikes from the Fed. It just happens immediately. That's why I think this bank crisis, or jam, if left to its own devices, is equal to about 100 basis points of tightening if it continues like this. A big bank failure is incredibly deflationary. By the way, it's perhaps the most deflationary thing that can happen in the entire economy. It's more shocking than endless rate hikes, but it gets the darn process over with, even with collateral damage that tends to be a lot worse. No, I don't want it to be this way. Believe me, this is a bad way to beat inflation, but it'll definitely do the job. And yes, today's shotgun wedding with First Citizens shows that some banks are ready to take on the troubled entities after they've wiped out. That was the new information from this morning. That mattered. I do recognize, though, that the Fed didn't tighten by 50 basis points last week precisely because of the next Silicon Valley Bank-style meltdown, which is still very much a real possibility as we go home this very night. What an oddity. What's good for the banks is regarded as bad for tech, especially mega-cap tech like Apple and Meta, Alphabet, Microsoft. Some wrong-headed people seem to think that you can swap weak balance sheet companies, the banks, for strong balance sheet companies, the tech titans. That's dumb as recycled boxboard, which is why these moves only last as long as you're far away from earnings season. Tech stocks trade on earnings, for heaven's sake, not on balance sheets. This market is incoherent. What's good for the bank gander is apparently bad for the tech goose. I mean, I don't know. Give me a Big Mac fries, Diet Coke. In the end, though, we still don't know what's going to happen to the deposit base of First Republic. Hey, let's cross our fingers. That could do it, right? The maddening psychology on the ground? But the bottom line, the longer this mini banking crisis drags on, the higher the Federal Reserve has to take interest rates. On the other hand, if a larger bank fails, the rate hikes, they could be kaput. Yeah, over. It'll get us through the end of the tightening cycle much faster. You don't have to fight the Fed anymore. Albeit you'll get there with a lot more pain and a lot more fright and a lot more panic. You go in Ohio, you go.
Jim, long-term viewer, big-time fan of your show.
Thank you, Hugo. Thank you for calling.
And my questions tonight are about two REITs. A few months back, you had the, I think, the chairman or the president of VC on after they took over the Texas property. I do too.
He's good, man.
But towards the end of that interview, I think you mentioned Penn National. And what surprised me about that was Penn National, years ago, spun off their properties into a REIT called GLPI.
Yes, it did. Yes, it did. You got worse sense.
Yeah. And what I'm wondering is...
He's talking about that. Yep.
Do you think that VC will make a play to take over GLPI?
I tell you, VC's got his hand filled with the last couple of deals. I like VC because I like consistent dividend payout. And that's what VC has. Penn is too up and down for me these days. Hey, let's go to Henry in North Carolina. Henry!
Hey, Jim. How's it going?
Henry, it's good. I got my voice today. No, there's no more ventriloquy. Is ventriloquism? I don't know. Let me Google that. Go ahead. What's up?
My question to you is, do you think that GameStop is a buy given its first profitable quarter in over 2 years?
Okay, this is a great question. Here's what I feel about GameStop. It is a cult stock. That means there are people who love it no matter what. The fact that it's making money, regardless of whether it's NFT exposure, whatever, I don't want to get in the way of it. People can take it where they want. It's kind of like Bitcoin when it's at 19,000. It's like, yeah, let's just take it up. I mean, a couple guys go, hey, guys, what else are we doing this afternoon? I don't know, should we get a haircut? I don't know, should we watch NCAA? Why don't we just take up GameStop? It's kind of like that. I mean, that's not the game that I like to play. Hey, change the channel. Take GameStop up. The longer this mini banking crisis drags on, the higher the Federal Reserve is going to have to take rates. It would take a larger bank failing and a lot more pain and panic to get us to the end of this tightening cycle. It could be a little frightening. Maybe tonight, it might be too soon to bottom fish with the regional bank cohort, but are there bargains to be had in some adjacent names that got punished unfairly? I'm revealing one stock I think you should keep on your radar. Then, you called me in and you stumped me on Champion X. So is the Champ the kind of stock that maybe work in this environment? I'll give you my take. And ChatGPT is the whole world interested in AI, including you. So I don't know, how about some new names to play? I'm getting tired of the old ones. I'm revealing the ones that could be worth watching. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.